This is the core. This is absolutely that sort of comfort food, meat and potatoes kind of portfolio.
This is Trillions ETF Master Chef, where we interview the chefs of the finance world on their hottest investment recipes.
Welcome to Trillions. I'm Joel Weber.
And I'm Eric Balchunas.
Eric, who'd you bring us today?
Today we have Gary Stringer of Stringer Asset Management. You could throw any ticker at him and he will have an opinion on it, and he's got a great portfolio to show us today.
What do you like about cooking with ETFs, Gary?
Well, it starts with our macro view. We're a global strategist, so we're looking around the world in terms of where we see economic opportunities or where we want to pare back risk, and then we turn to the ETFs and construct portfolios that best match our outlook.
Okay, so you call this recipe your conservative growth portfolio. Who's this specific recipe for?
This specific recipe, our conservative growth strategy, is really designed for those investors who are at or near retirement, or those who are just wary of all the market volatility that's out there. So you can get capital appreciation, but do it in a more conservative manner.
Is this one that would be for the core? Because a lot of times we have people on the show who make little dishes for the side, or is this the main meal here?
This is the core. This is absolutely that sort of comfort food, meat and potatoes kind of portfolio.
Okay, so biggest holding in this entree, what is it?
The long-term allocation is 50% stocks and 50% bonds. So the single largest holding is a core bond holding.
And that single allocation is SPAB, that's 21% of the portfolio. And that just tracks what? Treasuries, corporates, mortgages?
Correct. Well, we use that SPAB as a core position, then we move around where we see value. So for example, we recently added some high yield bond exposure as an alternative to equity. So rather than subject clients to, with all the geopolitical risks that's going on today, we can pivot that, bring those equity assets back to the US in high yield bonds and still generate a nice rate of return without subjecting people to all the headline risk that's out there.
One of the things that's interesting about the equities you have is this emphasis on sectors. So there's financials, there's healthcare, there's tech. Why specifically those sectors, and which ETFs are you using to harness them?
These three areas are some of the areas that we like in terms of both the opportunity to play some defense, like XLV for our healthcare positioning, but we're also owning things like tech, which tends to be very consistent earnings over time. And then the financials position, similarly, we think financials have taken a beating recently. But if this is not an economic recession in the US, and we don't think it is, there's a lot of upside to those names.
Okay, you've got these three sectors. You've got a value ETF in here, some factor ETFs for momentum. At some point, couldn't you just replace all that with like SPY? How do you know this is actually doing something and not just creating like the color gray?
So one of the things about ETFs that we really like is the transparency. So we can peel the onion back and look at the individual holdings and sectors that we can then emphasize where we want to be. So for example, if we had just on the SPY, we just own the US equity market, large caps. But there's some sectors in there that we think are overly expensive, and there's some sectors that we think are relatively inexpensive. So we put together a series of ETFs that when we think about creating a recipe, you put together several different ingredients that balance each other out, and still with that emphasis on where we would think the opportunity is. So in some areas, we want to add a little more spice. Because if you just own the SPY, you'll be very, very bland, and you'll be subject to whatever whims of the market might there be at the time.
A lot of this is stocks and bonds, right? It's essentially some form of the 60-40 portfolio. Both of those are down this year, obviously. I know you have some hedges in here, but what do you say to somebody who is a little older, who has a bunch of stocks and bonds? Should they hang in there? It is weird they're both down. It's not supposed to be like that.
Right, they're both down, but yes, you should hang in there and you should have a risk-first kind of strategy. And they're both down because you have interest rates moving higher based on higher inflation, et cetera. And that's the way we manage this portfolio, is that prior to interest rates moving higher, we hedged a lot of that interest rate sensitivity. So we really protected on the downside. So this is a core allocation for that type of a retiree that they can hold all the way through, because it's that balanced strategy, that 50-50 is starting point. And that's really what it's designed to do. And in fact, historically, a strategy like this hasn't had a down 5-year period. So if you give it just enough time, you'll make money and you'll be just fine.
So I set it, forget it, and retire.
That's correct. You set it, forget it, retire, and we'll manage the risk for you.
Gary Stringer, thanks so much for joining us on Trillions ETF Master Chef.
Thank you for having me.